Good morning. Thank you for joining. I hope you're all very, very well. Things are never quiet, but between the spring tides, the floods, and the market plunge, September was certainly tougher than usual. The exciting news is that we've launched 2 new funds, and I'll talk more about that after the positioning slide today. But first, let's have a look at the really awful markets in September. As you can see, September certainly was a risk-off month. There really was nowhere to hide. The best return was, funny enough, from South African cash, which beat dollar cash. So it's quite surprising that in this huge risk-off, the rand didn't weaken more. Perhaps at 19 to the dollar, it's already weakened enough, and there's no more cushioning that can be provided. We'll be watching that quite closely. But certainly an interesting point, or at least data point, that the rand didn't weaken much further in the month of September, given, as you can see, hugely negative returns from a variety of asset classes. US equities down 5%, world equities down 5%, South African equities down 3%, some big moves. Tech in particular was very hard hit, 4th down 8%, FANG down 6%, and that was primarily driven by high interest rates in the US, with growth stocks being hardest hit, but also a number of tech-specific data points which came out during the month. Google's antitrust trial has begun. Amazon was sued by the US Federal Trade Commission, and Apple lost $200 billion in market cap despite launching its exciting new iPhone 15 because China stole the limelight. China released, well, Huawei released the Mate 60 Pro, which looks like it has faster download speeds than Apple. Everyone thought the chip tech ban on China would prevent anything like this from happening, and yet China seems to be doing just fine, even without the ban, with great download speeds. And at the same time, the Chinese government said they may be banning government employees from using Apple phones. And between that news, the Huawei news, and the Apple ban, there was quite a big move in the Apple share price, $200 billion. So a lot going on in September, particularly in the tech space, with the higher for longer interest rates, the big move. So let's talk about that. We had Bank of England's chief economist, who has called for the Table Mountain scenario for developed market interest rates. Basically higher for longer interest rates, because inflation is going to be higher for longer. So interest rates are going to go up, and then they're just going to plateau, like the beautiful Table Mountain backdrop. But that's not what happened to bond yields in September. Instead, they just carried on climbing. There was no plateauing. Bond yields went up and up and up, and equity prices came down as a result. So there were 2 big drivers for this movement. One was the oil price, which, despite being down 12% in the first half of 2023, jumped more than 30% in the 3rd quarter of this year. So higher oil prices had markets spooked, because obviously oil is a big driver of inflation. Higher inflation means higher interest rates. So that was the one cause. But the second cause was the US. And the US data, which looks much more resilient than people were expecting. This recession that everyone was expecting doesn't look like it's happening anytime soon. And so the market started to digest this higher for longer, which we've been saying since the beginning of the year. Higher inflation for longer. There's a more resilient US consumer, and as a result, the markets started to digest this higher for longer process, and bond yields went up, and markets came down. It certainly seems to be a bit overdone, and our cautious positioning has worked very well, but we have taken profit and closed out a portion of our underweight in equity, just because we have had a very negative August and September, and there's still some resilience in the US and the rest of the world, and China as well, starting to certainly not look as bad as it once was, as it was feared. Definitely not great, and there's still no bazooka stimulus, so there's not going to be a raging bull market. But the collapse that was feared is not there, and they seem to be holding steady. And that talks to the divergence that we have seen in central bank announcements over the last month. So China cut interest rates, or at least their reserve rate requirements again. whereas the US was steady and did not raise rates, while the EU did raise interest rates, and Japan also kept their monetary policy steady. So a lot of different views, but looking forward, we seem to be at the peak of or at least the end of the interest rate hikes, and moving into this Table Mountain scenario of flat for longer at a higher level, which yeah, is certainly something that we were expecting, but it is something that does impact markets, because it means high interest rates for longer, higher debt payments for longer, and that certainly will impact profitability. It will impact consumers. It'll be a headwind. Because interest rates do work with a lag, normally 12 to 18 months. And so we still have yet to see the major impact on the consumers as a result of these interest rate hikes. But I'll talk more to that when we get to the outlook. But that was the big driver of September, was interest rates, and the higher for longer scenario, driven by oil and driven by US resilience. So jumping into the US, who drive global interest rate markets and drive global currency markets with their interest rates and the dollar. And we had the September FOMC, where Fed Chair Jerome Powell kept rates flat, as I said, but very hawkish on the outlook, which is, again, the playbook. The Fed's job is to try and not cause a recession. So they try to not have to hike interest rates. And the only way they can do that is by talking tough, so they can talk down inflation expectations. If they can talk down expectations, then they don't have to do anything, and then they don't have to push the economy into recession. So once again, talking tough. And he said, the Fed needs to get to a place where we are confident we can bring inflation down to 2% over time. So as I mentioned, although they kept rates flat, they did remove some of the cuts from next year, and they also increased the inflation forecast for next year. So to some extent, accepting higher inflation with higher interest rates. What we've been forecasting as a baseline, because the last thing the Fed wants to do is cause a recession, and they certainly would like to inflate their way out of debt. As we've said in many places in the past, the biggest hurdle to the world is debt. Debt to GDP is at all-time highs. And when you start having to spend more money on your interest payments than anything else, well, that is a big issue. And South Africa is starting to hit those constraints. We'll talk about it as our budget deficit, which is looking horrendous, paying far too much on interest service costs. But that's a global phenomenon. And that happens, growth slows, job creation slows, and the world really grinds to a halt. Best way to get out of debt is to inflate your way out, and just make that debt in real terms become smaller and smaller and smaller. So the Fed doesn't want to cause a recession. They don't want to cause job losses. The best way to get out of the debt is to inflate. So they certainly are going to accept inflation being higher. They're not going to panic, but they are going to keep rates a little bit higher for longer. So one of the reasons that the market sold off was US resilience, and the big driver there was US retail sales, which beat expectations and confirmed that resilience. And the market seems to be trying to work out what's going to happen in the US. From the end of last year, the market was forecasting a recession in the US at the beginning of this year. We weren't. We were overweight equities. We were overweight risk. We thought that there was just all this COVID savings that could be used despite high interest rates, that high interest rates work with a lag, and that has worked out in practice. But we're getting to the point now where those high interest rates are starting to take effect. And the market is more and more undecided as to where we're going to go. So you think of a coin, and you're flipping a coin. If the coin lands on heads, it's a recession. If it's tails, we're going to see a second wave of inflation. If it lands on its side, well, that's the Goldilocks scenario of no recession and no second wave inflation. It's I believe, as hard as getting a coin to land on its side. But that's what the Chicago Fed is predicting. They say that the Fed has done just enough interest rates to bring inflation in line by the middle of next year without causing a recession. So just that perfect Goldilocks scenario of enough interest rates to keep wage inflation in check without causing huge amount of unemployment. And that may be the case. The Fed certainly doesn't believe that to some extent in terms of inflation outlook, and that's why they were a lot more hawkish than people were expecting in the outlook. One of the things that could result in a Goldilocks scenario is the labor force. So you can see the chart on the right. The black line is showing the number of people that are employed in the prime age group, that's ages 25 to 54, and you can see that the black line is higher now than it was before COVID. So during COVID, you can see how both lines dropped, unemployment, or the employment levels dropped, people lost their jobs or chose not to work. And since the end of the lockdowns and COVID, people in the prime age group have returned to the labor force, and that extra labor force is keeping wages in check. However, the 55 plus age cohort is still very depressed at the dotted blue line. So to some extent, there's people saying, well, I just couldn't be bothered. I've got all my retirement savings, and I'm going to start to use those savings when my COVID savings run out. And that seems to be the case. Certainly, some of those people might come back into the labor force. If they do, it'll help keep the labor or wage inflation in check, which will help keep overall inflation in check. But it's not certain yet whether that's going to be the case. And wage inflation might continue to be sticky, and that's certainly what the Fed is looking to. But we certainly believe that the coin is weighted, that the lower probability is it lands in the case of very strong US growth, very strong resilience, which causes a second wave of inflation. We think that's maybe a 30% chance. We think that landing on on tails of the coin is probably closer to 70%, and that's just because of all the headwinds. We've got a frozen home market, so people have bought homes, they've locked in good mortgage rates, 30-year mortgage rates, but interest rates have spiked, and they can't afford to sell their home and buy a new home at these higher interest rate levels. So we've got a frozen home market. We've got very tight lending standards. We've got depleted COVID savings, and all of that's going to lead to a slowdown in growth and a slowdown in inflation. So we think 70% chance of a soft landing, mild recession in the middle of next year, probably 30% chance of the US keeps going and is resilient and causes a second wave of inflation, which causes the Fed to hike even more, and then a 0.0000000% chance of landing on the exact side and the Goldilocks scenario. Not zero, but it's certainly unlikely. To some extent, markets were pricing in that scenario. Markets were definitely, at the end of July, markets were pricing in that perfection of landing on the side of the coin. But now that we've had a sell-off in August and a sell-off in September, markets are more realistic about the outlook, and I think much closer to pricing in our scenario of a mild slowdown into the mid next year when looking at the US. Still, not expecting a massive recession. There's no way we're looking at 2007, 2008, because there aren't imbalances. They're not major imbalances anyway. Home prices in the US have stabilized, and US consumers have paid down a lot of their debt. So we think a mild pullback is certainly something to expect and nothing to be too worried about. But we are positioned for that slowdown. As I said before, the US remains the cleanest shirt in the laundry basket despite all these headwinds, and so we are overweight the US and overweight the dollar. One of the other risks that I haven't mentioned that could again cause a slowdown into the first half of next year in the US is the United Auto Workers strike. The last time that happened, which was in 2019, we saw commodity prices in particular sell off, with US steel falling 15%. So certainly a headwind for commodity prices, and another reason to be cautious in terms of overall risk positioning. Okay, so new face to our webinar. Here we have European Commission President Ursula von der Leyen, who is calling for tariffs to be imposed on Chinese EVs, arguing that they're being sold at artificially low prices as a result of Chinese government subsidies. So very bold move from the EU. I certainly don't believe the EU can afford a trade war. Ursula is suggesting a 27% tariff increase on Chinese EVs, the same as the US. But I don't know if they can pull it off. Certainly, China has threatened to retaliate with tariffs on cars and luxury goods. The US is pretty insulated. The US imports and exports make up about 85% of the GDP. They really can afford to be as arrogant as they are. Whereas the EU and Japan and South Africa are open economies. We rely heavily on global trade, and it's very difficult to start trade wars or tariff wars with China. Just looking at some of the data points, just to support that. And this is actually quite surprising. I don't know if you're all aware, but BMW, Porsche, VW, Mercedes, they generate roughly a third of their EBITDA from sales to China. So a third of profits from those big German luxury auto manufacturers is selling into China. That's a massive amount. I hadn't realized that. But it is changing, and this is what's causing all the concern. German market share in China has dropped from 25% just 4 years ago down to 19% this year. And at the same time, German imports of Chinese vehicles have surged 57% over the last year, and that's driven purely by EVs. And that's what got EU Commission President Ursula quite upset that these cheap EVs are flooding the European market. And it's a global phenomenon. China has become the largest seller of EVs globally. And what is allowing them to do this is that they're the biggest manufacturer of EV batteries. They've got the prime share of the commodity resources that go into those batteries. They've got the highest supply of those batteries, and being able to supply cheap EV batteries is making their cars far more affordable than other EV manufacturers, and they're taking the global market by storm. And that's having huge impacts on all sorts of things, and I'll talk about its impact on oil. At the same time, we've got German central bank warning that 29% of German companies import essential parts from China. And while geopolitical risks are rising, and a lot of the US in particular is trying to move away from China, it's much easier for the US to do that. With a third of German imports, critical imports, not overall imports, but essential critical imports coming directly from China, they can't just suddenly turn off China as a near global supply chain. So unlikely that the EU can afford a trade war with China. They are very interlinked. And that's certainly also showing with European growth. Right now, European growth has slowed dramatically because of China's unexpected slowdown. And that's why, despite the EU hiking rates in September, so the ECB hiked rates by 25 basis points to the highest level in 22 years. I mean, that's quite something, 4.5%, 22 highs at ECB rates. And despite that, the euro lost 5% to the dollar over the month of September. And that's just showing that even though the US didn't raise rates, the market believes the US is resilient and they can raise rates if they have to, not that we expect them to, whereas Europe is struggling because they are so dependent on global growth and they're so dependent on China and global trade. And with the slowdown in China, there's just no scope for the EU to carry on hiking rates. And similarly, there's just no scope for a huge trade war between the EU and China, not in the short term anyway. I mean, they may try and move away, but EU, Japan, South Africa, emerging markets, all very, very dependent on global trade. And that's being impacted by the incredible rise in China's EV sales and EV battery sales, and the commodities that are linked to that. So that brings us to an interesting segue on the oil outlook. And certainly, as I mentioned, one of the reasons that we saw the market sell off this month, and one of the reasons that bond yields did rally so much this month, is because oil is up strongly, and there's the concerns that that will continue, and that's going to slow down growth and push up inflation and basically push the world back into a recession. So some quite big concerns about what's going to happen with oil. The irony is that the International Energy Agency, the IEA, came out this month to say that the world is at the beginning of the end of the fossil fuel era. So just as oil prices are rallying, the IEA is saying it's all over for coal, it's all over for oil. We're moving on to renewables and nuclear and other sources. So one of the big drivers for this is China. So the IEA's forecast that demand for oil, natural gas, and coal will peak much sooner than expected. The peak will happen before 2030, and that is driven by China. And they're expecting that China will reach peak gasoline demand by 2025. That's just over a year away. China's EV sales are about 40% of new car sales, and that's expected next year, 2024, to be more than half. So just a year away from China selling more than half its cars in the EV space. And as China being the world's largest oil user, that definitely has a meaningful impact on the demand outlook for oil. But in the short term, oil's up. The chart on the right just shows in purple, you've got demand contribution to pushing up the oil price. And in green, you've got the supply contribution to the oil price. And you can see that over the last couple of months, demand has been relatively stable. Certainly, even though China, there's been this fear that it's collapsing, it seems to be okay. Yes, it's not rebounding strongly, but it's carrying along just above recession. The PMI is just above the 50 level. Demand stable and growth relatively stable. But what we've had is we've had incredibly disciplined supply cuts from Saudi Arabia. And those supply cuts have, you can see the green just at the end there, those supply cuts have pushed up the oil price at the margin. And we've also had some supply cuts from Russia that were unexpected due to some domestic disputes that are happening there. And that's pushed up oil. Now, there is a risk that can continue. If oil prices remain elevated, it could knock off 0.5% of global growth over the next 6 months. But at the same time, Iran's supply of oil is growing, and Saudi Arabia is unlikely to extend their cuts into next year if the oil prices remain at these high levels. Of course, the big wild card is Russia. The big wild card is geopolitics. Certainly something that we've been worried about. And while one of the reasons that we think our coin is 70% to the downside and 30% to strong growth and inflation is because the wild card is that we see high oil prices and geopolitics and the war in Ukraine and Russia escalating, which pushes global growth into the downside. It's certainly not our base case, but we do think that is a possibility. So yeah, looking lots of interesting movements in the oil price, big movements in the renewable space and the electric vehicles, and that landscape changing a lot faster than people were expecting, certainly a lot faster than IEA was expecting, and China being a lot more resilient, particularly in that space than the market was expecting. So on to South Africa. The good news is that South African bonds are even more attractive than they ever were. The interesting news is that South African equities, even though if you look on an absolute basis, I mean, you look at the price to book, incredibly cheap, price to earnings, incredibly cheap. They're looking cheap on an absolute basis and a relative basis. But one of the many measures you can use to look at asset class valuations is the price of bonds versus the price of equities. Basically, the yield on dividends, which again is quite high in South Africa relative to the past, and an absolute level, 4.5% dividend yield, and you compare that to what you earn in bonds. But because South African bonds are so incredibly cheap and offering so much value right now, that gap is the highest in the world, which means, ironically, that compared to all other equity markets, South African equities are the most expensive in the world right now. it's just one data point. We don't it's definitely caused by the huge concerns that are impacting the bond market, not so much the equity market, but it is just fascinating to show that that's how cheap South African bonds are, at least relative to SA equities, that they're the cheapest in the world on that risk premium basis. But again, there are risks. Part of the reason is that South African bonds are so cheap is global bond yields have gone up. But the big reason is it's a huge buffer. The real return gap is just massive, nearly the highest real return in the world. With inflation sitting at just over 4.5% in South Africa, bond yields nearly 12%, got a massive real return. So what is a big concern? Well, the big concern is the South African budget deficit. And here we have Edgar Sygnia, the head of Treasury's budget office, and he's saying we aren't going to spend our way out of our current problems. And that is certainly the case. Well, we don't have the money to spend our way out of our current problems. And our revenue projections are 21 billion rand below expectations. That's definitely something to be worried about. And in fact, South Africa's budget deficit rose to a record 143 billion rand in July. That is a massive amount, the biggest monthly budget deficit in record. So we have our medium-term budget policy statement that is normally at the end of October. It's been pushed out to 1 November, and we'll certainly be watching that with keen interest to see what happens. National Treasury said they are going to cut expenses. They can't afford to raise taxes anymore. They have to cut the expenditure side. What will they cut? Certainly, cutting anything is a concern. But cutting social grants is highly unlikely. We've got elections happening next year. There's concerns about social unrest. So what will they cut? I do think they are going to cut something. I do think they are going to try and get a more balanced budget. It's not going to be a great budget, but they are going to get some cuts through. They're probably going to make promises they can't keep, like promising for a lower wage growth, which hopefully the market will take as reassuring, even though no one believes it because they never ever get it. They always promise 0% wage growth, and it's always much higher than that. So we'll be watching to see what happens. But the big concern is that in the past couple of years, revenue has surprised on the upside, so it's allowed for some expense drag to happen, and it's allowed National Treasury to keep paying higher social grants and to keep missing their expense budget because they've had windfall revenue coming in from commodities. Commodity prices have fallen because of this China slowdown, and those windfalls aren't coming. We've also had load shedding, which has been an absolute disaster for growth, an absolute disaster for corporate profits. So one of the biggest reasons that our revenues are dropping is not just commodity falls, but overall corporate revenues are down. That's why one of the reasons South African equities are down. Profits aren't there because of load shedding, because of a lack of investment. It's just looking really, really tough out there. So reforms, as always, are desperate. We desperately need reforms to get Eskom fixed, to get SOEs fixed. One of the big drivers of reforms is the social compact, Cyril's social compact. That social compact between labor and business and government, very important to developing a framework for us to move forward. That was promised within 100 days of its announcement. We're now over 600 days and counting, and still nothing. Government is pointing their fingers at everybody, but the one thing that labor and business have in common is they're both blaming government, saying the government is dragging their heels, and nothing is getting done. And that is unfortunate, and there's nothing new. Meanwhile, we've got Transnet begging for a relaxation of preferential procurement. So right now, the preferential procurement policy is forcing them to use a middleman to ensure that they have appropriate BEE. But what that's doing is it means that they can't contact the original equipment manufacturers directly, which means there's a delay in fixing what needs to be fixing, most importantly, and delays can't be afforded. Also, it's pushing up the costs of any maintenance far higher than it would otherwise be. So we've got delays, we've got expenditure overruns, and South Africa just can't afford higher expenditure overruns and delays when there's just no revenue to meet those higher expenses. Pravin Gordhan has promised the biggest shakeup of SOEs since 1990s to try and stimulate and accelerate reforms. But unfortunately, there wasn't much detail in that proposal. So we'll have to wait and see exactly how replacing one government entity with another one fixes something. Yeah, it's certainly, I'm not holding my breath on that one just yet. And lastly, it brings me to the chart on the right, which is just a reminder that South Africa is a small, open economy. And often we do very well despite ourselves, and often we are hurt despite what we do. We are heavily reliant, like the EU, like Japan, on global trade, heavily reliant on foreign direct investment, FDI, and right now we're on the losing side of that. The chart on the right just shows FDI over the last decade. The blue line shows FDI into the countries that voted to condemn Russia's invasion of the Ukraine. The black is the total, and the purple is the FDI into countries that did not condemn or abstained in terms of Russia's invasion of Ukraine. And South Africa, unfortunately, we did not condemn the invasion, which is horrific from a humanitarian perspective, but it's also horrific from what it's doing to our country in terms of foreign direct investment. You can see there we're getting no FDI. It's not just load shedding that's causing foreigners to stay away from South Africa and our own goals, but it's also the fact that we on the wrong side of that vote. And foreigners not wanting to invest in countries that are supporting the war and the invasion. So that is unfortunately very sad. It means less investment, means less job creation, means less growth, means less tax revenue. That's where we are right now. So yeah, things definitely aren't looking great. China as well has been very hurt by FDI. They have seen the lowest foreign direct investment in history over the last year. And the biggest benefit or beneficiary is Mexico. So companies like Tesla, General Motors, and Kia are piling into Mexico, billions of dollars in investments as they try and move their supply chains away from China, away from countries that voted to or failed to condemn Russia, and moving into more Western-friendly countries like Mexico. Mexico's currency has boomed, and the FDI has boomed, and they're certainly, despite the rest of the world slowing down, they're seeing very, very strong growth as a result. So, unfortunate that another own goal, and one of the reasons that we are struggling the way that we are right now. But we still believe that South African bonds offer value, and we do think that some very high yields that if you can handle the volatility, they're not the same as cash. If you can handle the volatility, then you're looking at some very exciting yields. Sure, there are going to be some questions on income maximizer. I'll talk to that when we get to Q&A. So that brings me to positioning, just overall where we're sitting. As I said, the world is pretty much undecided. We're sitting at a tipping point. So if we look on the positive side, we've got the fact that the US is resilient, one. Two, we're moving into positive seasonals. So everyone knows sell in May, go away and come back at St. Leger's Day. And that's where we are right now. So you should have gone away, you would have done well. Time to come back if you base your investment strategy on seasonals. Thirdly, we've got the chart on the right, which shows that global manufacturing may be stabilizing. So that is new orders in black and new orders minus inventories, which are leading indicators, and they're ticking up. So what happened? Well, you can see there that in the big spike around 2020, during COVID and lockdowns, everyone was stuck at home. They couldn't travel. They couldn't go to restaurants. So they bought more iPads and new cars and computers and TVs, and manufacturing boomed. At the same time, supply was constrained, and we had inflation, and it was just a mess. Then you can see here at around mid-2022, we had lockdowns end, and there was all this pent up savings. People already had 2 cars and many iPads, and so they traveled, went to restaurants, spent on services, and manufacturing went into a depression. Below 50, it was recessionary. But now that is rebalancing, and manufacturing is starting to normalize, and people are starting to travel a bit less. And replace their laptops. Intel is starting to see, finally, after a couple of years of really poor numbers out of Intel, they're starting to see the laptop and home PC market recover. That's just another data point to show that we're starting to see a nice rebalance of services and manufacturing. Manufacturing will certainly help global trade. It'll help Japan. It'll help Europe. It'll help emerging markets. It'll help China. So there's your third reason to see some positive news into the end of the year. Positive news from global manufacturing, positive news from seasonals, and a more resilient US. At the same time, we've still got huge headwinds coming from high interest rates. And high interest rates are at 22-year highs across most of the developed world, and that works with a lag. And we're starting to only now just feel the impacts of those high interest rates. And that's certainly going to impact the consumer. Not only that, but only now are we running out of the COVID surplus savings in most of the world. So we've got high interest rates that are kicking in. We've got a depletion of those COVID savings. And that's going to lead to that resilience that we have seen start to unwind. So it's kind of balanced right now. We've got some green shoots coming through, but I think the stronger impact is the slowdown. So we're going to see services continue to slow, and manufacturing continue to recover, possibly supported by China, which is still a very, very stimulative economy, very low interest rates, lots of government support. So between China and the manufacturing green roots, that will probably just keep the world just above recession. And certainly we're not forecasting a recession for next year, just a slowdown. And markets are reflecting that already, and that's why we have reduced our underweights. But we still think there's a lot of volatility to come, and we're certainly not getting bullish anytime soon. We're not quite sure. And even if we do have a mild recovery into end of the year, I'm not quite sure how sustainable that's going to be. So we'll be watching the data. So less cautious than we were, taking some profits on our underweights, but still slightly cautious given the headwinds. So that's our positioning. It's our outlook. Then 2 exciting news items in terms of 2 new funds that we launched. I hope you all saw the news. We had a very exciting news last Friday where Sygnia launched our first actively managed ETF, the Sygnia FANG AI actively managed ETF. And Eva had a fantastic webinar. I hope you all saw the webinar. If you didn't, the webinar will be available on our YouTube channel, and you can have a look. But just to summarize, it's an exact replica of our FANG unit trust. So the FANG unit trust is also being rebranded. The ballot has been approved, and that should be happening soon in the next 2 weeks. No changes to the underlying investment philosophy or process for the FANG unit trust. We're just renaming it. Why? Well, because FANG has become something that's more just an idea, a philosophy for the big global platform companies, and both the actively managed ETF and the unit trust, they invest in global platform companies that use technology to acquire and retain users. That's what they do, and that speaks mostly to the big stocks. So that's Apple, Amazon, Microsoft, Google, or Alphabet. Those big FANG stocks, Meta, but they've all changed their names. Google's now Alphabet, and Facebook's now Meta. Microsoft was never part of the original FANG, but they are now. So we needed to update the unit trust deed just to keep it relevant, because those companies just don't exist, and they were hard-coded into that. So the FANG unit trust had a deed change. We did change the name from FANG Plus to FANG.ai because that is more relevant, and that's the same name as the actively managed ETF. So no change to the unit trust philosophy or process. It's still got a big weight in those FANG stocks. They make up over half of the fund. The other half is cognizant of the NYSE FANG benchmark, but far diversified, because we can't have 10% stocks in a 10% weight in some of those small cap stocks. So we diversify those over many other companies. But the philosophy remains focused on large global platform companies that use technology to retain and acquire users. And that the reason the FANG companies have done so well when it comes to AI and large language models in particular is because they have the cash flows and they have the captured user base. And that's the model that we like. That's why we love the FANG stocks. That's why they're doing well in the AI space, because they're positioned to take on new technologies and adopt them. And more importantly, they have the cash flows to just acquire new businesses or competitors and adopt them. So one of the big risks is antitrust. Certainly something that we've been worried about, certainly something we've spoken about. And as I mentioned in the opening slide, it's something that is right now is topical with Google's lawsuits ongoing, Amazon being sued, Microsoft and Google fighting about default browsers. It's something that is there. But as we know, in the US, unlike China, these things move very slowly. And antitrust is something that takes time to happen, and we don't think there are going to be any huge impacts to profitability anytime soon on these businesses. So while those risks exist, the business models and the moats are still there. It's one of the reasons why Warren Buffett's Berkshire Hathaway's biggest stock is in or biggest weight is in Apple. It is just a fantastic business model. So that's the launch of the actively managed ETF and a rebranding of our unit trust. So you now have two options. If you want to go into the unit trust and you're happy with 3 o'clock pricing, that's there. If you want to try and time your entry point and you want to buy at 10 a.m. or you want to buy at 4 p.m., then you can get into the actively managed ETF whenever you feel the need. The other fund that was launched in September is the Sygnia Transnational Equity Fund. That's very exciting. It is not available in your trust just yet. It is live on our platform. So if you've got a retirement annuity or a living annuity or an endowment, you can invest into the transnational fund through our platform. It will be available in your trust quite soon. You would have seen a ballot which has gone out and has been approved, where we are converting the Sygnia Swix Equity Fund into the Sygnia Transnational Equity Fund. And this just talks again to South African growth and South African equity. So the Transnational Fund, in a nutshell, it looks at the large cap South African companies like the Swix universe, and it then filters for companies that have a majority revenue which is offshore. Then once that's happened, we then control for sector risk, and we control for concentration risk and cap it, and we come up with the portfolio as it is. So the point of the fund is to give you exposure to companies that have predominantly offshore revenue. And so that means if you're concerned about South Africa slowing down, if you're concerned about South Africa's equity earnings falling because the consumer is under pressure, because of load shedding, because of lack of foreign direct investment. If you think that retailers are going to be under pressure, that banks are going to be under pressure, if you don't see a turnaround in reforms and state-owned enterprises anytime soon, if you think that all those headwinds are going to stay, well, then the Transnational Fund is a place for you. It gives you exposure to the JSE listed, so it's South African companies, JSE listed companies that have predominantly offshore revenue. So the top 5 stocks are the usuals. It's British American Tobacco, it's Anheuser-Busch, it's Richemont, it's Naspers and Prosus. It's those big global companies that are listed in South Africa and it overweights those to try and give you a more defensive positioning. So it's there for people who prefer or are concerned about South African growth and want exposure to global revenues while still being listed in rands. So obviously, if you've got discretionary money, you can get a more diversified basket by just taking your money offshore. You can invest into the Sygnia MSCI World ETF, or you can invest into the Sygnia Skeleton International Equity Fund of Funds, 100% offshore, 1,500 companies, very diversified. But if you're in an RA, retirement annuity, and you're limited to 45% offshore, and if you're in a living annuity and you're capped at 40% offshore, and you want to get more equity exposure than that 40% limit, and you don't want exposure to South African revenues, well, then this is a position for you. You can switch out of South African equity baskets, and at a very low fee, at a passive fee, you can get exposure to global revenues that are listed in JSE. So very exciting fund available already on the life license for retirement annuities, living annuities, and endowments. And soon, we just, as I said, the ballot has been accepted, approved. It's just probably a few weeks until we implement, but soon our Swiss unit trust will be converted into the transnational fund, and that will give investors exposure to worldwide offshore global revenues on JSE listed South African companies. Okay, let's have a look at Q&A. Okay, the first question, as I guessed, was on income maximizer. And the question from Ellen says, why did income maximizer underperform the STFI by 1% over the last quarter? So Ellen, the important point on income maximizer is it targets income. And so people that can withstand capital volatility. So if you look at the income from income maximizer fund, and our fact sheets have been adopted to give you that income split, the income has been very stable. Income has been around 10% annualized each month over the last year. The capital price has fluctuated with bond movements, and we think that'll continue to happen. Yes, bonds are cheap. Yes, we do think bond prices will appreciate, but that depends on a positive budget, and it depends on US bonds strengthening. So there are a lot of headwinds in the short term, but if you can afford that capital volatility in the short term, you don't need to access your capital. If you're in a living annuity and you're just happy to access that yield, well, the yield is not impacted by those movements. The yield is invested in government guaranteed bonds. South Africa, yes, even though our budget is going to be tough, South African bonds are not going to default, not rand bonds anyway. We have a printing press, we can print more bonds. And so there's not going to be a default. And if you want 12% yield and you can afford the volatility, then income maximize is for you. And if you look on the fact sheet, you'll see there that while the total return is down over the last quarter, the income is way ahead of the STFI fund over the last quarter. So if you're concerned about total returns, then you should be in the Skeleton Balanced Absolute Fund, or the Sygnia Money Market Fund, or the Sygnia Enhanced Income Fund. Any of those funds are cautious from a total return perspective. But if you're just worried about high levels of income, maximize your income, then you have two options. Either you can invest directly into bonds, or you can invest in the income maximizer fund, where we actually have a higher yield in bonds right now, because we've got some bank NCDs in there, and a lower risk than bonds. So you're getting a much nicer risk return balance than going directly into bonds. But you still have that capital volatility. So income maximizer is for people with slightly longer term horizon that can afford that volatility. Andre asked a great question. So Andre says, what are the implications of restructuring of secondary listed foreign companies like Richemont and BHP Billiton falling from 20% of the top 40 index to less than 4%. Andre, that is, so I should have mentioned that. So one of the catalysts for us launching the transnational fund was this restructuring. So up till now, the all share had a huge exposure to offshore revenues. The Aussie index had 25%. 25% of the Aussie at one point was in Richemont. It had over 10% to Anglo-American. It had over 10% to BHP Billiton. So those three alone, plus Naspers was over 10%. You know, the Aussie index was nearly the same as our transnational fund. But we have this concept of index harmonization. The JSE is doing away with the Aussie. It's quite complicated because what they're doing, because the Aussie has a better track record, they are rebranding the Aussie to the Swix and shutting down the Swix. So it looks like the Aussie is being shut down, but actually what's happening is the Swix is being shut down, it's being moved into the Aussie track record, and the Aussie is being renamed. The bottom line is you're right. The Swix methodology is what's going to happen going forward. So instead of having Richemont at 25%, you're going to have Richemont at 3%. Instead of having Billiton at 12%, you're going to have Billiton at 3%. Similarly with Anglo-American, Anglo Gold. All those companies that were grandfathered into the Aussie when the Swix started, they're all being downrated. So if you are worried about, if you're currently invested in the Aussie, and you're worried about the sudden collapse, I mean, it is a huge difference in transnational or offshore revenues from Richemont, Anglo-American, Billiton, Anglo Gold, all being down-weighted. Well, then the answer is the transnational fund. So yes, that was one of the primary reasons why we started this process many months ago. It obviously takes a while for a ballot to go through with the FSCA, but many months ago we started this process because of index harmonization. So it does give you that alternative. Thank you, Andre. Great question. Mr. Naka, I believe that I have answered your question on the labor force participation. It hasn't at an overall level got back to pre-COVID levels, but that's because the prime 25 to 55 cohorts that is above, but overall is being held back by the over 55s. EJ asks how the merger of the Sygnia Fourth Industrial Revolution ETF and the Sygnia SE ETF. So EJ, just to point out there is some confusion. So we have two ESG ETFs. One is Sig ESG. There's no change to that. That is the Sygnia Global 1200 ESG Index. That's very similar to Sig World, which is the MSCI World Index. It tracks the S&P 1200 Global ESG Index. So Sig ESG is the same as Sig World. It's just got a very small, very low tracking error ESG overlay. And it has a very small allocation to emerging markets, less than 5%. So you can really think of Sig ESG as the same as Sig World. What we did have was Sig SE, the ETF. And Sig SE was the Sustainable Economies ETF. And Sig SE was roughly, it took roughly half of the fourth industrial stocks, and it took those half that were focused on sustainable investing. So those half that had exposure to stocks fighting climate change, stocks with low carbon footprints, stocks that are focused on renewable energy, and we launched that ETF. But there wasn't a big support for that. I don't know if it's because people just don't care about climate change, or if it was just too similar to the fourth industrial revolution, but there wasn't a big support for it. So we're merging those two funds. And so if you are currently a holder of Sig SE, the Sig SE ETF, the Sustainable Economies ETF, after the merger, you will be holding the Sygnia Fourth Industrial ETF. So that means half your stocks will be roughly the same, because Sig SE was roughly half of Fourth R, but you'll go from 300 stocks to 500 stocks, and you'll get exposure to the full basket of Fourth Industrial Revolution. And so that is, if you want to see what your fund looks like, just look at the fact sheet for the Sygnia Fourth Industrial Revolution ETF. That's what you're being merged into. So there's no change to the Fourth Industrial Revolution ETF. If you are holding the SE ETF, SIG SE, you'll be given 4th units in exchange for your SE units. Again, that ballot has been approved. We're still waiting on final implementation details of that. Those should be coming out soon in a SENS announcement. George says, what is your view on British American tobacco? George, I don't really have a stock-specific view on any stocks. I can tell you that British American tobacco is a staple, and we do like staples. So again, a great question, because one of the things I forgot to mention on our positioning slide is that we retain our cautious outlook. So we still underweight equities, we still overweight global, and we still overweight the US. But one of the changes that we've made over the last month was we switched some direct US investments into staples, consumer staples. We do think with this, again, with a slowdown, that it's a great time to be invested in some of these fantastic global businesses that have annuity dividends and revenues, because people have to eat food, people continue to drink alcohol, continue to smoke when there's a slowdown. So we think it's a defensive position, just like we have about healthcare. We think healthcare is a great defensive position in a slowdown. So we remain overweight healthcare, and we've in all our global equity funds. So whether you're in Skeleton International Equity Fund or Skeleton Balance 70, all our global equity carve-outs are the same. We've added in consumer staples, as we think that's a good place to be. So back to British American tobacco, it's part of staples, so we like the sector. It's got a phenomenal dividend yield and great shareback regime, but at the same time, it is also an ex-growth company, as the vaping is definitely not making up for the slowdown in overall tobacco usage globally. So it does have some headwinds, but those are very much priced in. So I can't tell you overall whether it's cheap or expensive. It's just got a great yield, and it's in a sector that we like, and it does have some growth headwinds. Daniel, I hope I've answered your question on SIG SE and SIG 4RR ETF. The amalgamation does not dilute the holdings in SIG 4RR ETF at all. There's no impact to existing SIG 4RR holdings. We just create new units, we buy more stocks, and those are given to the new investors. So it doesn't impact the existing holders at all. Question on the transnational fund. The transnational fund is not similar to the S&P Core Shares 50. The transnational fund is quite unique. It's an active fund that we produce, Sygnia produces, in terms of selecting companies that have higher or predominantly offshore revenues. I'm not exactly sure how the S&P Core Shares 50 is created, but that'll be a passive index, whereas ours is an active fund. Sean, good question on our website. Thank you. It is under construction, and we're always striving to make that better and better, and hopefully there will be an update soon. Teresa says, are transnational equities coming into Skeleton 70? Not as yet, Teresa. For the moment, we're keeping South African equities within Skeleton 70 as is, in terms of a more diversified portfolio. We may include it as an allocation. We may switch some of South African equities. Well, so we did move from the SWIX to the cap SWIX within our balanced portfolios. So we're comfortable with that for now. We may move to transnational equities, but as of yet, we're sticking with the cap SWIX. And Teresa, I think it's a good point to make onto the transnational equities. So as you know, we have the Sygnia Divi Fund, which is a fantastic fund. It invests in companies that have high dividend yield and have effectively value stocks. And over the long term, we think that will beat the index, and that is why that fund has one of the fee classes on that fund has 0% management fee and only has performance fee. And that fund had phenomenal returns. It was number one over every time frame, but it was very overweight resources because resources were giving the great dividend yields. Now we have reduced exposure to resources in that fund, but it's still overweight resources in that as resources have pulled back this year with the China slowdown, the Divis fund performance in the short term has not been great. So, as I said, just to reiterate, one of the important design points on the transnational fund is that it is sector neutral from a resource perspective. So it will move up and down with the capped SWIX in terms of its resource exposure to ensure that the resi financial industrial split doesn't impact performance. But within resources, it's transnational funds, and within industrials and financials, it's transnational funds. It's just a risk limit. We also have a concentration cap limit on the transnational fund to avoid having any stocks more than 10%. Okay. Harshad says, does index harmonization affect the top 40? So yes, so index harmonization doesn't impact the SWIX 40 or the capped SWIX 40 or the SWIX or all share. Harmonization impacts the ALSI 40 and the all share index. Those two, which currently have or had big exposure to Richmond, Anglo-American, Billiton, Anglo Gold, those indices are being made to look like the SWIX, and so they're keeping their name, and they're made to look like the SWIX indices, which is a rather complex way of doing things. But basically, the SWIX remains, even though the SWIX will be called the all share. And the top 40, the current top 40, will become the SWIX 40. Dominic says the transnational fund has a performance fee. Dominic, that's not right. The transnational fund is going to be invested, we're converting the SWIX unit trust into the transnational fund. The SWIX unit trust didn't have a performance fee. We may launch a performance fee class on the transnational fund, and it'll probably be similar to the Divi fund, where we launch a new fee class, which is 0% management fee and a performance fee. But we haven't launched anything yet, and that decision has been made, so there aren't any performance fees on the transnational fund. If we do, it won't impact the existing fee class, just as we didn't in the Divi fund. We launched a new fee class. So it'll be optional whether you want the performance fees or not. Mike says, what is the difference between the transnational fund and the Sygnia top 40 ETF? So again, as far as index harmonization, one of the ballots that you'll see come out is the merger of the SWIX 40 ETF and the top 40 ETF. We don't need an ALSI 40 ETF and a SWIX 40 ETF, because when index harmonization happens in March next year, they're going to become the same thing. So those are being merged as well. And both will follow the new methodology, which will be the SWIX methodology, even though it's called ALSI, and that'll have a low offshore revenue. So, good question, maybe to put in numbers. We think that the offshore revenue of the SWIX index, sorry, the new ALSI index, will be around 60%, whereas the old ALSI was around 80%, and the transnational funds offshore revenue is about 95%. So I think those are some good numbers to use. That's after index harmonization, the all share and the SWIX will have about 60% foreign revenue, whereas the transnational fund will have 95% foreign revenue. So that's, you can get a feel for how that fits together. Howard asks a question on BRICS and the new BRICS currency. Howard, again, it's exciting that the BRICS has expanded their membership, but that just means they're less likely to make any decisions. And they've got such diverse ideologies that I don't think anything's going to happen anytime soon. I think most likely China is going to launch digital currency. They might try and get some bandwidth out of that. China continues to open up its capital accounts. They continue to try and make their equities and their bonds and their currency more tradable. Certainly something that could help Chinese equities is at the moment they cap their onshore, their A-share equities at 30%. So foreigners aren't allowed to hold more than 30% of their equities. They're thinking of reducing that cap. If they do, passive funds that currently have about 3% exposure to China, that could double or triple. And we could see a lot of passive flows pumping up China if they relax those flows. But certainly China is working to become more and more internationalized markets. BRICS currency as a whole, unlikely unless China can strong arm Russia and India and everybody else. But I don't think that's going to happen in the short term. Mike, another good question. When do you expect the new platform to be available? I'm going to say soon. Things seem to be on track, and I'm told it is soon. So watch for some updates there. Sean says, what fund would you recommend for high yield and relative monetary risk for younger professionals? So Sean, you've asked for two different things there. So if you want high yield, then I would suggest that and low risk, then Sygnia Enhanced Income Fund is a great fund. That focuses on income, enhanced income. You're getting 10.5% yield on that fund with very little capital volatility. So it's a great place it's certainly far more stable than Income Maximizer. But if you're a younger professional and you want moderate risk, if you're looking at total return, then you probably want a bit more equities, and you probably want more of a balanced fund. So depending on what you're looking for, if you're looking for moderate risk from a balanced fund, total return, then maybe skeleton balanced 50 is appropriate. But if you're focusing on the yield side and you want a cautious yield fund, well then Income Maximizer is giving you a decent yield, and it's certainly less risky than a bond fund or enhanced income. So I'm not sure exactly what your time horizon is on that. Yuri asks, will we be able to access a recording of Recession? Certainly, all our webinars are recorded. They're all put onto our YouTube channel. So definitely, this should be available quite soon. And you can have a review of the entire presentation on YouTube. And that's all the Q&A. So a nice short one today, probably because of school holidays. I hope that you enjoyed the presentation today. I hope that it was beneficial and useful and you learned something. And I look forward to seeing you all next month. Have a great month.